Modern portfolio theory is concerned with risk and return on the portfolio as a whole. And the reason why they should care about the portfolio as a whole, rather than thinking about collecting a bunch of hot tips, is because if they carefully diversify, then when one part of the portfolio goes up, the other part of the portfolio will, when one part of the portfolio goes down, typically another part of the portfolio will go up, and they will, diversify some of the volatility away. But there is a trade-off between risk and return, and portfolio theory traces out for them what their risk-return trade-off is, and they should carefully pick the risk-return trade-off that's appropriate for them. Well, it's twofold. One is to get a proper balance suitable to themselves between stocks and bonds and cash. Look over some charts that show you how volatile the equity markets, the stock market is, and get a balance between stocks and bonds that's suitable to yourself, that you can stick with for the long run, and get a diversified portfolio of stocks through some diversified low-cost investment company, a mutual fund, and balance it with bonds or CDs. The chief mistake which small investors make is they buy when the market has been going up and they think it will continue to go up, and they sell when the market is going down and they think it's going to keep going down. So they buy dear and they sell cheap. The best advice I would have to you is first, get this balance between stocks and bonds that you are willing to live with in the long run. And understand there is volatility in the market. Like 2008 was a big loss. The large cap stocks went down 38%, but it wasn't the biggest loss ever. It was sort of tied for the second biggest, and most of the time the stocks make 10-12% on the average over the long run. So you got to get a balance between stocks and bonds and cash, which you can live with in the long run. Now, having got that stock, that balance, don't watch CNBC. Don't watch Jack Cramer. Don't value your portfolio. Once a year, when you do your taxes, value your portfolio. But other than that, forget about it. You've got your strategy, and you're implementing it, and let other people go crazy about their stock portfolios.